All right, that ended as a complete dumpster fire, but this is episode 17, and today we are talking about free trade versus protectionism, if the 60-40 portfolio is dead, and how to get your yard ready for winter. Milton Friedman said that if you put two economists in a room, you'll get three opinions. However, this is not true when it comes to trade policy, as almost all economists support free trade. Despite their consensus, protectionist policies like the use of tariffs have been used commonly throughout US history. Alex, do you think protectionism is good or bad?
Well, I am absolutely a protectionist. I'll just start like with 1990. Let's look at the trade deals since then, and you can even apply this to the ones before. They're all sold to the American people by promising things like more jobs, lower unemployment, fewer people on welfare, higher wages, lower real consumer prices, more economic security for the US. But what they've consistently led to is the exact opposite. There's net millions of jobs lost due to these trade deals. We've netted higher unemployment numbers, more people on welfare. We've seen wages suppressed in real terms, minimal discernible changes in real consumer prices. And for displaced workers, they're usually higher. Basically, we've just gotten more dependence on foreign imports. Every time we've tried protectionism as a policy long-term, however, we've seen higher wages across the board, millions of middle-class jobs created, fewer people on welfare, lower real consumer prices, and increased national economic security. To me, free trade really only works if you're a small country, like say you're Belize, your only natural resource is like a nice beach or two. It doesn't make any sense to tax imports when you can't get anything locally. And it makes a lot of sense to eliminate trade barriers if you want to maximize the amount of capital you get from like tourists and then import all the stuff you can't get from home. But that doesn't describe us. The US has the capital, the geography, the manpower, the natural resources, the infrastructure, et cetera, to produce excess quantities of literally everything we need and want. We simply put, do not need free trade, and we don't get anything out of it. The promises of free trade, meanwhile, have all failed to materialize, and the only real responses I've seen to these by the diehard proponents are either learn to code or that wasn't real free trade. Protectionism, to me, is by far the better real world policy for the US, and I think all the data bears it out pretty consistently.
Joe?
I don't know if it's possible for me to disagree anymore. I have to say that I'm a big component of free trade. If you think about it in terms of this, let's say that for the sake of argument, that China is going to heavily tax their citizenry to come up with the cash to create goods, manufactured goods to dump on the US markets at incredibly low prices so that Americans can have quality goods and services a lot cheaper than their own Chinese people can. I'd say, let's let the Chinese people do that. Now, there's only four outcomes. There's the outcome where you don't have any free trade. And then there's certainly the outcome where only one of the countries in the relationship is open to free trade. And then the exact opposite, where the other country is only open to free trade. And then the fourth option is where they both refuse to trade with each other. The best outcome is when individuals are left alone by governments to buy and sell as they see fit. If you think of it in terms of a Christmas present, just about everybody would prefer cash than have their mother buy them a sweater. Because if the mother gives them the sweater, it's going to be the wrong color. One sleeve's going to be too long, but we go buy the sweaters we want with the cash that mom gives us. So quite frankly, I think it's bad for a country to even consider protectionism. And if we take a look at history as an example, the Smoot-Hawley Act passed by the Hoover administration was the start of the Depression. And then many of the continued protectionist problems that were created by FDR took a 2-year recession and turned it into a 16-year Great Depression. I don't think there's any historical precedence for protectionism working well. And I think the exact opposite. I think that free trade, like we saw during the 1920s, is plenty of examples of why it's good for individual buyers and sellers to be allowed to do so without a whole lot of government interference.
Drew?
I'm a fan of free trade as well. I think there's certainly a lot of pros and a lot of cons with protectionism versus free trade. One of those pros perhaps is in the example that my dad made with the mom and the sweater. It certainly makes mom feel good when she gives a sweater and the kid pretends to like it. And a pro for protectionism in Alex's case, yeah, I think the U.S. can survive on its own with the resources it has, but just because you have an absolute advantage doesn't mean that it doesn't make sense to trade. I think overall there are more cons than pros under protectionist policies. To put another way, I think it ultimately does more harm than good to those it's trying to help. I think an important question to ask is, at what cost? There's no free lunch, right? In the short term, protectionism is supposed to create more jobs. It's supposed to boost tax revenue, decrease trade deficits, amongst other things. But these only seem to occur in a vacuum. What protectionism fails to account for is people have free will and people respond to incentives. And whenever you change one variable in the equation, it's going to produce different outcomes. Just for an example, let's think of a grocery store. It's not like the grocery store can simply just start charging $20 for a bag of apples and expect to sell the same amount of apples. People will choose to buy more bananas. If prices on all the fruit go up, they may simply learn to do without, or there will be less money available to buy bread or shampoo or other things. The point is, protectionism thinks it's helping the grocery store owner, and it might in the short term, but in the long term, it'll probably end up putting them out of business, and all the while it's going to make all the consumers upset. I guess another negative outcome is it gives local producers a perverse incentive to stop innovating and developing. As a consumer, I want the highest quality of goods for the cheapest possible price. And I think the way to get there is through free trade.
And to Drew's point is that in America, I think people have free will to do whatever they want, but I'm not so sure that's true in other nations in the world. Now, free trade requires that all nations play by the same set of rules. Some nations, like China, don't play by America's set of rules. Nations that don't play by our rules practice unequal competition, and each nation that creates self-serving rules, or each nation that creates its self-serving rules doesn't have free trade. So the fact that America practices free trade and the Chinese have artificially low labor costs because they essentially pay their workers, at Foxconn like $1 an hour, and they got 12 of them living in a box. And so they can sell cheaper steel in the United States isn't necessarily everybody playing by the same set of rules. If you get everybody playing by the same set of rules, then I think free trade actually works. But when you have governments manipulating the rules for their own self-serving purposes, then you have issues. Specifically, you have national security issues. And that's where protectionist policies actually, I would say, actually help. Because even though ideally you don't want broad sweeping like tariffs or other types of policies, but when the Chinese have quotas on how much natural resources they can export or how much they pay their workers, again, that creates an unfair advantage. And then they also manipulate their currency, and that creates a lot of national security issues for the US. So the US, instead of having a broad sweeping policies, they should have very strategic policies that focus on the things that China and the Japanese do that manipulate their currency and make it unfair for the US to compete. And I know Alex wants to say some other stuff, so I'll just let him go.
Since the Roaring Twenties were brought up, I have a few things to say about that. Number one, the Roaring Twenties are a result. Number one, they were still a largely protectionist time period in American history, especially compared to today. But the more important thing to note about the Roaring Twenties, it's a combination of two things. One, it's a post-war economic boom in the United States after half the world's major powers imploded. And number two, it was a debt-fueled bubble. I looked up the data. The beginning of the Roaring Twenties, total debt as a percent of GDP was 154%. By the end of the Roaring Twenties, it was nearly 300%. The reason is businesses and consumers who for the first time ever had cheap, easy access to credit basically went on a buying spree. And it only lasted 8 years, and it ended in a huge market crash, followed by a whipsawing between a hard turn to protectionism again, followed almost immediately after that by FDR's big free trade push. FDR was not really that protectionist during the Depression era. They went really hard. He campaigned on free trade. Number two, same thing basically since the 80s, early 90s, another period of, mass debt expansion and a rise in free trade. These are debt fueled bubbles. Whereas you look at like the period of between the Civil War and the beginning of like the progressive era in the late 1900s. This is the highest period of GDP growth in American history, averaging 4.5% a year, better than the 1920s, better than the 80s, better than the 90s. This is without any doubt the best period of economic growth and expansion in the history of this country. And that was the most protectionist time in American history. And at the time, there's lower debt as a total percent of GDP than any of the other big expansions. So they did it without debt and they outperformed everybody.
Well, when we're talking about debt, I think you're talking about private debt, like the individual citizen, the individual business. But during the 1920s, it was the closest we came to having a balance. We did actually have a balanced budget, but it was the closest time for the United States being almost completely debt-free with that economic expansion. I think the argument for debt is really a function, or private debt or corporate debt is a function of whether or not we should have a Federal Reserve, because the Federal Reserve wasn't even around until 1913, and it really came into expansion during the 1920s, when for the first time laissez-faire economics policy allowed people to be stupid. But the fact of having FDR come in and try to make people intelligent, I don't think it was a fair trade-off to have 16 years of depression when the problem could have been solved in a matter of a few months, or I'm sorry, in a matter of a couple of years, if we had just let the losers get their balance sheets off the table and people who are smarter with money to come in and pick up the pieces and have the phoenix rise from the ashes.
All right. Well, I would say that at least for the like 1870s to 1890s, the big issue was the American government was paying off the Civil War debt, which it had racked up. Beyond that, though, I agree about the Federal Reserve System greatly incentivizing the creation of a lot of private debt. That is part of the problem, but I think that's a totally different discussion. So I'll just leave that one alone.
All right. There have been a number of articles floating around the financial journal stating that the 60 portfolio is dead. The 60 portfolio is named after the stock to bond allocation, which makes it 60% stocks, 40% bonds, and has been one of the best performing buy and hold portfolios on a risk adjusted basis. Drew, why do you think it's dead, and do you agree? Or why do you think people are saying it's dead, and do you agree?
The topic's come up in the finance world a lot recently, and I don't think it's any reason to panic, to rush out and change your portfolio. I think the reason people are talking about it is because interest rates are low, and quite frankly, the 60-40 model has been underperforming its average recently. I don't really like this conversation. When people talk about the 60-40 model, they tend to create a false dilemma. The only satisfying answer is the 60-40 model is totally dead, or it's still the paragon of investment models. I think a better question to ask is your financial plan and your portfolio congruent with your goals and objectives? Our clients know, or at least I hope they know, that we take a holistic approach when managing their assets or giving advice. We don't blindly follow some model and forget about it. It's more of a process. We're constantly monitoring our model portfolios, and sometimes certain investments are in favor and sometimes they're out of favor. When it's prudent to make changes, we do so, and when it's not, we leave them alone. Right now, the 60-40 model is currently out of favor, but I still don't think that's a reason to panic if that's how your model's set up. The 60-40 model is viewed from its historic returns, which are roughly about 9%, I think, going back to the 80s. That doesn't mean that every year it's returned 9%. It means obviously that some years it returned way more and some years it returned way less. And right now it's returning lower than 9. If you're one of those buy and hold, do-it-yourselfer types of investor, yeah, maybe spend some more time and review your portfolio, but otherwise just seek professional advice.
Alex, what do you think?
So the 60-40 portfolio, yeah, I do kind of think it's dead as maybe the basic idea, unless you're maybe willing to go out and buy Afghan bonds or something. Um, some interesting math was, if you had $250,000 in a portfolio in 1991, and you wanted to put 40% of that into, say, a 30-year treasury, you were getting, what was the number? 8.03% for 30 years locked in. That paid out about $670 a month in addition to your Social Security. That's pretty good. If you did the same thing today, they're paying 2.13% as of today, this morning. It's $177 a month. It's not a whole lot of money. You'd need nearly $1 million instead of $250,000 to come up with the same amount as 40% for a 30-year treasury. We had a similar discussion about this kind of thing a few episodes ago. And so right now, really it's just, you have to go find yield somewhere outside of treasuries or bonds. And, that means increasing risk. So just something you have to be cautious about, make sure you're not taking more risk than you can tolerate. But as far as 40% being treasuries, unless you have a lot of money, they just really don't pay anymore.
Joe?
To Drew's point, I think it is a false dilemma where we bifurcate either or, and I don't think that's a fair assessment of the 60-40 rule. I tend to treat the 60-40 rule as just another type of medication you have in the medicine cabinet, that if you have a particular need and the 60-40 is the best choice, and that's what you do. Quite frankly, we haven't been using the 60-40 anywhere near as much now as I may have done back in the 1990s, but that doesn't mean that in 2023, I might switch. There was a time not too long ago, gentlemen, where we were putting a lot of these in portfolios when we had that short period of time where we had interest rates paying 3.5% on a 5-year CD and 2% on a 1-year CD. And we're still enjoying the benefits of that decision. If we had said the 60-40 rule is dead, we never would have taken advantage of those great interest rates for that short period of time. And our clients with those longer term CDs wouldn't be still enjoying the returns they're getting today. So no, I think it's a little harsh to say that it's dead. I think it might be out of season, but I think it's something that every competent financial advisor should keep in their toolbox and use it if it's deemed appropriate.
People are saying it's dead because when 40% of your portfolio is made up of bonds and interest rates are at historical lows, and there's talk that they're going to start coming up, that means that 40% of your portfolio is at risk of taking it on the chin. So, back in the 1970s, when we went from fairly low interest rates to really high interest rates, the 60-40 portfolio did terribly. Stocks and bonds became more correlated, and you basically got the worst of both worlds inside the 60-40 portfolio. And so basically you're coming up again to another environment that's going to be similar to the 1970s, where we're going to go from low inflation, relatively low inflation, to a period of potentially high inflation. And that just historically has not worked out well for the 60-40 portfolio. Hopefully, if that's the portfolio you're using, it's going to be a short period as opposed to a long period. So hopefully get a shorter period where interest rates rise quickly and then kind of stabilize. And then you'll start seeing the 60 portfolio be the well-performing risk-adjusted portfolio that's been known to be. But if it takes 15 years for interest rates to normalize, that's going to be a horrible period for your portfolio, because typically they don't do that. And this is kind of the part where you can make a strong case for active management, because active managers right now they don't have long-term government treasuries in there. They have bank loan CDs, they have high yield bonds in their portfio. They have dividend paying stocks, and they're able to move those assets around based on what's going on in the economy. And if you're a buy and hold, if you're somebody who's using the 60-40 portfolio in the decumulation phase of your life, it's going to be a rough couple of years for you, because the economic environment that supposedly is coming is a real harsh time for a portfolio that's greater than 50-50. So if you have 60% stock, 40% bonds, that's going to be rough. But if you use the age appropriate portfolio, where you basically take 100 minus your age, and that's the amount of bonds you're supposed to have in your portfolio, people who are in their 70s are going to take it on the chin. And hopefully they have a better strategy than just using one of these rule of thumb buy and hold portfolios.
This argument it's not new news. Bond yields are historically low, but they've been low for a long time, haven't they? I think the 30-year treasuries have been below 4% for the last decade, and been below 5 or 3% for the last 5 years. It's not like all of a sudden they go down another 1.5% and the 60/40 is completely dead and the scales have tipped. Another thing to note is that low long-term interest rates are fundamentally a huge positive for equity prices. So just because bonds are taking it on the chin doesn't mean that the equities are going to pick up some of the slack there.
Right. If inflation gets high, equities, even though they tend to outperform bonds in these periods, still are probably going to take it on the chin, at least initially. And typically when inflation gets high, stocks and bonds become more correlated in these types of markets. Joe, everyone knows that in Montana, winters can be fairly harsh. What are you doing to prepare your farm and your yard for winter?
Funny you should ask that. That was my last weekend chore, was putting away all of the hoses and the sprinklers. And I'm starting now to break out the de-icers for the water buckets for the animals. That's really the big issue. For me in the wintertime, the biggest struggle on the ranch is making sure the animals have fresh water, because some nights it'll freeze solid if you don't have a de-icer in there. That's mainly the main things for us is to make sure that we drain all of our hoses, get them put away, make sure everything is picked up this time of year, because if it doesn't get picked up, you might not see it until spring. So any farm tools or farm equipment, if it's not under a shed, it's going to be buried for several months.
Alex, what are you doing?
So for my lawn, I do an early fall standard fertilization, and that helps keep it going into the fall. But in later fall, so this is coming up, generally a higher nitrogen fertilizer, because I want the grass to get thick and rapid root growth to store nutrients for the winter, so that when it goes dormant, we can expect that it's going to come back green instead of come back brown and have to be thatched out and reseeded. Usually I do this, it really is weather dependent. When I mow the lawn for the final time around it, when it looks like it's going to hit 50 during the day for the last time, and then that's when you do it. So if or when it stops getting around 50, then I'll finally cut the grass one last time and do that.
Drew, what are you doing?
In the fantasy version of myself, I kick all the weeds, and I fill all the bald patches with compost, and I rake all the leaves. But the reality is I've done about jack to my lawn, and I probably won't do anything. It's been on the back burner. I've had a whole bunch of other house projects to do. So once the first snow falls, I'm checking out.
That's what I do with my old house, is that I didn't even put on a lawn in my old house in the first year. I just let the snow cover the ground, and I got an extra 6 months extension from the HOA to put my lawn, because nobody could even know nobody knew if I had it there or not. This year, number one thing is getting the chickens water figured out, because last year I'd have to go out there with a metal rod, break the ice, kind of like Joe does. Except my thing is I'd always put the metal rod through the watering dish, so it didn't matter. Once the water thawed, it all flowed out of the ditch because there was a gigantic hole in the bottom. So this year we are trying to figure out a way to put a heating element in there and then elevate the water source, so that A, it doesn't get dust in it, and B, it doesn't freeze. And lastly, so I don't have to go out and fill it every other day. And then last year I had leaves. Thankfully we didn't get a lot of snow, so I had leaves that I was able to compost from last December. And all the leaves on my tree are falling off right now, so I have tons of composting material. So I mowed my grass for a lot last time. I put all the grass clippings in there. I put the leaves in there. I put the chicken coop material in there. And so I got myself a pretty decent sized compost pile this year. And so we'll see how that turns out. All right, to end this episode today, we're going to end with a lightning round of questions where I'm going to try and get through at least 5 questions in 30 seconds. And I expect a one word, one sentence answer. So we're going to put 30 seconds on the clock and we'll get started. All right, so question 1 is that who do you expect to see in the World Series?
I don't.
Astros and Braves.
I don't watch baseball, so.
So yeah, Astros and Braves.
I have no comment, no opinion. I don't watch baseball either.
Now, I would love to see LA and Boston, but I feel like after watching last night's game, it's probably gonna end up being Atlanta and Houston, which is really disappointing. All right, number 2. Would you rather own a Bitcoin ETF? Would you rather own the shares of the Bitcoin ETF that was launched this week, or would you rather own actual Bitcoin?
I'd rather own a Bitcoin ETF.
Same, ETF. Seems like it'd be easier to buy and sell.
ETF.
Well, I don't understand why you would want to own an ETF that's basically based on futures when you can actually own the actual Bitcoin. So I'm going to go with, I would rather own the actual Bitcoin. It's nothing, I mean, it's not backed by anything anyway, so you're buying nothing in either case, but I would rather hold, the more original nothing.
Are we allowed to explain ourselves? Or
Sure, you can explain yourself, and since I'm
the
the
moderator
moderator, I
always
can
gets
take
to-
all the time I want.
No, that's fine.
Should the stock market be open 24/7? So no weekends, no holidays. It's always open. You want to trade at 3 a.m. You're able to do it.
Should it? I don't think there's enough demand to do it, but there already is after hours trading at 3 a.m. No, you probably can't trade in the U.S. equities market, but you still get a few extra hours. I think that's perfectly fine.
I'd say yes. It's, digital world. Everybody's doing everything at all hours of the day and night. Everything's global. Why not?
Free market, baby. If there's a market for it, people should be allowed to trade stocks if they want to.
Yeah, I have no problem with 24/7 market trading. That sounds fine to me. I'm not showing up at the New York Stock Exchange in all hours of the night making trades. So what do I care? And I forgot to time this. All right. Should a steak be well done or not?
Not. That's how I like it.
Okay. Alex is frozen. Joe, why don't you go?
Absolutely not. You ruin it when you cook it well done.
I'm gonna go in between. I'm gonna go medium rare. I think I can't tell if Alex is done or not, but so we'll just leave him alone. But our last question is that all right, yeah, he's gone. So all right, last question. Drew, was the last Halloween costume you wore?
It was a pirate.
Joe?
I was a flasher.
Yeah, I saw that picture on Facebook. If you weren't going to say it, I was going to bring it up for you. But yeah, I think I was like, geez, I can't even remember. I think we was like Super Mario or something like that. It was the last one we did with the kids, and I think it was like Little Bo Peep. Oh, maybe it's like Little Bo Peep, and I think I was like a shepherd or something like that. I don't know, but that was it. So. All right, so I think that might explain the last question for Alex. I don't even know what's going on there anymore.
He's muted.
Looks like he's having a great time though. All right, so I think we'll just call it the end. So that's it for episode number 18 of Farm to Market. Thanks for joining us. We'll see you next week.